We are doing a deep dive into some really surprising real estate data. We're looking at the London, Ontario, and St. Thomas marketplace, and specifically the numbers that came out of December 2025. This is, essential stuff if you're a potential home buyer, seller, or investor. And just so you know, our analysis is all built on data and expertise sourced through Forest Hill Real Estate, the Distinction branch in London, Ontario. For some really expert guidance on how to navigate this market, you can find them at www.foresthilldistinction.com. But the big takeaway, right out of the gate, December was actually the strongest it's been since 2021.
The momentum we saw in the final month versus the reality of the whole year.
Right. If you just look at December in a vacuum, it feels like a really strong finish. We saw 398 homes sold across the Elstar region.
And that's a powerful number to end on because that was actually up, 0.8% compared to December of 2024?
Just under 1%, yeah. And more importantly, it made it the strongest December the region has seen since 2021.
So that suggests buyers were suddenly back and keen to close before the calendar turned over.
That short-term momentum is definitely real, but we have to pull the lens back a bit to the annual summary to sort of temper that excitement.
So how big was that full-year decline?
Well, if we zoom out, the overall picture shows the market really slowed down in 2025. Over the full year, a total of 6,938 homes were sold.
And that's down from 2024.
It is. That total is a 5.0% decline in sales activity compared to the full year of 2024, a pretty significant drop.
But the overall volume for the year was down quite a bit. It feels like 2025 was the year the market finally sort of caught its breath.
That's a good way to put it. 2025 was a year of nervous waiting. Buyers were hesitant because of rates. Sellers were a bit reluctant to list.
So if I'm a buyer or a seller right now, which trend do I watch? The December spike in demand or the long-term slide in volume?
I'd say you watch the velocity, not just the volume.
The speed.
The speed, yeah. To figure that out, we have to look past just the total sales and focus on the balance of supply and demand. How quickly are newly listed homes actually selling?
And that brings us to the sales to new listings ratio.
Exactly. That's the metric that tells us everything.
Okay, so for anyone who's not familiar, why is this ratio the ultimate metric for figuring out who has the negotiating power?
Well, it measures how many of the brand new listings actually sold within that same month. So it's the best way to understand market speed.
Right.
When that ratio is low, homes sit and buyers have the power. The Canadian Real Estate Association, CREA, they generally say a balanced market is somewhere between 45% and 65%.
So below 45 is a buyer's market, you can make some demand.
Exactly.
Above 65 starts to get into strong seller territory.
Precisely. And this is where it gets really, really interesting. In November, we were sitting comfortably in that balanced range. The ratio was 49.5.
Okay, totally normal.
Totally normal. But in December, the ratio didn't just move, it surged dramatically, all the way up to 71.6.
Wow. That is a massive acceleration.
It's huge, and that ratio was the highest we recorded for Elstar in all of 2025. It suggests buyer fatigue might have suddenly broken, maybe speculation that interest rates had peaked, or maybe just year-end planning.
Whatever the reason, if you listed your house in December, the odds of it selling quickly went way, way up.
They did.
But wait, hold on. I have to challenge that. If it's a seller's market again, shouldn't inventory be, plummeting?
Yes.
This is where that inventory paradox you mentioned comes in. We have this aggressive sales ratio screaming, we're running out of houses.
Right.
But the data shows inventory stayed high. It was at 5.4 months in December. That's actually higher than the 4.6 months we saw back in December 2024.
And that's the tension. That's what needs a closer look. How can the market show signs of fierce competition? That 71.6 ratio, while the number of homes for sale remains historically high at 5.4 months.
If I have 5 months of homes to choose from, why am I suddenly fighting over a listing?
Because that 5.4 months of inventory doesn't necessarily mean 5.4 months of good inventory. It suggests that a lot of what's sitting on the market, that 5.4 months worth, is stale. Maybe it's overpriced, maybe it's poor quality. The desirable homes, the ones that are priced right in good locations, those are the ones driving that 71.6 ratio.
Buyers are only competing for a very specific small slice of what's available.
Exactly. If you're a seller with a perfect home in a great neighborhood, you are feeling that 71.6 ratio.
Yeah.
But if your property has been sitting since October...
You're feeling the drag from the 5.4 months of inventory.
Precisely. Buyers have choice, but it's skewed toward properties they don't want. That forces them to compete intensely for the ones they do want.
which means sellers of that quality inventory have some serious leverage. Which, I guess, brings us perfectly to the price. What did all this do to what people were actually paying?
Let's look at the average sales price, the ASP.
Okay.
The price picture really reflects that month-over-month bump in activity. The average sales price in December was $614,000.
And that's up from November.
Correct. It was an increase from the November ASP of $605,000.
So about a $9,000 jump.
In 1 month, yeah. It just reinforces that little surge in demand we saw at the end of the year.
A healthy gain. But that's just the 1-month picture. What about the yearly context? We already know 2025 was a cooling year overall.
That's right. So despite that monthly gain, when you look year over year, the December ASP of $614,000 was still 3.4% lower than the price back in December 2024.
So the recovery is starting, but we're not quite back to where we were a year ago.
Not yet. We haven't caught up.
This is probably a good moment to clarify for everyone listening. The difference between that average sales price and the MLS Home Price Index, or HPI. Why do we need both?
It's a great point. The average sales price, ASP, it's just the simple average. You take the total money spent on homes and divide it by the number of homes sold.
Simple math.
Simple math, but it's easily skewed. If, say, a handful of multi-million-dollar luxury homes sell in 1 month, the overall average price can spike.
Even if the price of a typical family home hasn't moved at all.
Exactly. It measures what's sold, not just how much things are selling for. The HPI, on the other hand, is much cleaner.
How does that work?
It calculates the value of a quote-unquote typical home based on specific attributes, size, age, location. So it filters out those wild swings and gives us a truer picture of underlying market values.
Okay, so what does that cleaner HPI data tell us about the overall L-Star market?
The L-Star composite HPI benchmark price, which is that overall typical home value, was $553,000 in December 2025.
And that gives us a baseline.
It gives us the baseline we need to really compare how specific segments are doing. And that's where the real insight is.
Okay, so what does this all mean for different housing types? Did that December demand spike lift all boats equally? I'm guessing the answer is no.
You would be guessing correctly, a resounding no. When you analyze the HPI for specific property types, you see a deeply segmented market. We compared performance to last month, November, and 3 months ago, September, just to see the trajectory.
Let's start with the biggest piece of the market, single-family homes.
Right. That segment had a benchmark price of $611,000, and they showed pretty good stability.
Okay.
They were down only 0.4% versus November and down 1.4% versus September. That's a minimal decline.
Okay.
It suggests the core of the market, the traditional family buyer, is holding pretty steady.
And what about one-story homes, the bungalow market?
One-story homes, their benchmark was $539,000. They saw a slightly bigger dip, down 1.1% versus November and down 1.0% versus September. Still relatively stable.
Now, let's look at the premium end. The two-story homes, which are often the most expensive.
The two-story homes were the most resilient of all, month over month. Their benchmark was $670,000, and they held completely steady, 0.0% change versus November.
Wow, totally flat.
Totally flat. Now, they were still down a bit over 3 months, about 1.7% versus September, but that immediate stability is really striking.
Why do you think that segment is so resilient? It's the highest price point.
It's all about the buyer profile. The two-story buyer is usually a trade-up buyer. They already own a home, they have equity, and they're moving up for more space.
So they're less sensitive to interest rates.
Far less sensitive than a first-time buyer. They're insulated from that initial shock, and so their segment holds its value much better.
That makes perfect sense. Okay, so where did we see the opposite effect? Where did the price pressure become undeniable?
That would be the townhouse segment. This is where you see a major fracture in the market. Their benchmark price was $435,000. Townhouses saw the most significant decline in value. They were down a huge 5.2% versus November.
5% in 1 month.
And down a hefty 7.1% versus September.
7% in 3 months. That is a staggering difference compared to the two-story market being flat. What is driving that weakness?
It really points to the buyer pool for townhouses. It's largely first-time buyers and investors who rely on affordability.
And they're the ones most exposed to financing costs. So the stability in detached homes is a sign of strength from established owners. But the sharp drop in townhouses is a flashing red light about the affordability crisis.
It is. If you're in the townhouse market, that price correction is fierce. It just reinforces that you can't look at the overall average price. You have to know your specific segment.
Absolutely.